Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Crude oil prices rose for a third straight session. In New York trading, WTI closed up 4.7% to 74.56, and U.S. diesel fuel futures rose 7.7%. Now, to be fair, prices did retreat from session highs after President Trump said the U.S. would provide insurance guarantees and naval escorts for oil tankers and other vessels passing through the Strait of Hormuz. That said, war with Iran shows no sign of de-escalation, and the outlook does remain precarious. For a closer look, I'm joined by Rob Haworth. He is Senior Investment Strategy Director at U.S. Bank Asset Management Group, and Rob joins us from our studios here in New York City. Thank you for being here. Give me your sense of what markets are dealing with right now in terms of war in Iran and how that compares with other periods of instability that you have seen.
Well, yeah, I've been in the business maybe too long, Doug, right? Thinking back to the Gulf War and other events like that, right? We've seen volatility like this before. I think the interesting thing this time around is the equity markets are a little calmer than the oil markets and the gas markets, right? We're seeing a lot more volatility there than we are in the energy markets. I think for us, what we continue to evaluate and what investors are trying to evaluate day to day is, one, how long will this go on? Right, we knew the Gulf War, for example, went on much longer than people anticipated. Right, is this really just 4 weeks? If it's 4 weeks, we can maybe wait a bit. Two, how high do oil prices go, and what impact does that have on the consumer? As we entered 2026, we think the consumer's a really important part of this economic story, and their ability to continue to spend amidst the refund season and other things, right, remains really important. So as long as energy prices don't get too high, that should be okay. And then I think it's a question of duration, right? I mean, we just have to think about duration. So I think markets have been a little calmer than we anticipated this time around, meaning equity markets.
The bond market, though, seems to be very concerned about the possibility that we're going to see accelerated inflation. That seems to be a prudent bet, wouldn't you say?
I think so, right? Because I think you have a Fed that is really evaluating the data as we press ahead. And we've heard that from multiple speakers, right? So maybe the Fed won't be cutting rates as quickly, and we need to embed some inflation expectations in what is still a fairly low 10-year Treasury yield at 4.1%. When you think about an economy that's growing at 2% with, depending upon how you measure inflation, 2.5% CPI inflation, 3% PPI inflation, right? I mean, you could have a slightly higher 10-year Treasury yield at this point. So I think there's room for it to move a little higher and accommodate those higher inflation expectations.
So if yields back up a little bit at the long end, to what extent could that destabilize the equity market?
Probably not as much, given where we started the first 6 months of the year, first 6 weeks of the year. Sorry, Doug. With that drawdown in software stocks, right? We've seen such a drawdown in technology that you've seen valuations reprice there, and what we're seeing is a fairly steady U.S. S&P 500. Tech stocks have been much lower. You're seeing better performance out of industrials and energy, where valuations had been low. So the interesting thing is we've probably seen that valuation reset in tech for the most part at this point, and there's probably doesn't have as much of an effect now as it might have at the end of the year.
That said, are you tempted to rotate a little bit internally within the equity space?
Yeah, we've been emphasizing global equities, which takes us away from technology. We've been emphasizing global infrastructure. We're probably a little rich at this point in the energy space, given oil has pushed up quite a bit, but we would look for more rotation and pay attention to diversification in smaller companies and in global infrastructure.
I was struck by the fact that in today's session, this is Tuesday evening, New York time, so Wednesday morning in Seoul, the Kospi is getting whacked quite a bit. Now, we know that as a part of this AI theme, some of the memory chip makers, names like Samsung, SK Hynix, have done exceptionally well. That seems to be being repriced right now. Is this something that you think global markets need to consider, the possibility that everything involving artificial intelligence needs to be examined just a little bit?
Well, I think part of what's going on in Asia is they're so dependent upon oil imports and energy imports that they're much more sensitive to the price of oil than we are for the moment. That said, I think there is a bit of a reset going on with artificial intelligence, but it's no less important, right? We certainly heard in earnings season the amount of investment in artificial intelligence infrastructure from the big hyperscalers is going to go up 30+% in 2026. That's certainly true globally. So there may be a bit of a price reset in the near term as everyone's rethinking their risk tolerance amidst this global turmoil, but there's probably a floor beyond it. And part of it, to your point, I mean, South Korea has had a tremendous run in the last 13 months, right? If we look at 2025, it was spectacular.
So what's your view on the macro right now in terms of the U.S.? You mentioned how important it is for the consumer to be able to participate. Maybe we can put a question mark over that at the moment, but are you still constructive in terms of where equities may end the year?
Yes, we are staying constructive, and I'd really highlight a couple of things. So one, if we look at the purchasing manager surveys that have come through, they're holding up very well. Now, that's pre-Iran conflict data, not post, but still, right, coming into it, those fundamentals were very solid. Retail sales we'll get Friday for another look, but certainly the weekly retail sales data is holding up well. And then earnings season has been very good for the fourth quarter and setting up higher expectations for the rest of the year. So we think the fundamentals are here, and drawdowns are an opportunity for people to start picking their positions as they press ahead for the longer term.
At what point do you begin to maybe consider the off-term elections, the midterms that we'll have in November, and whether or not, if, let's say, the Democrats were to regain control of the House, whether that is going to be a significant development for markets? What do you think?
Yeah, what we typically see in midterms on average is, yes, a little weaker performance going in and a little better performance coming out. But statistically, it's not very different. I think we're going to have to be much later in the cycle for the market to really start to pay a lot of attention to midterms, because right now the president is very much in control of his agenda. He has the tools he wants and needs to implement tariffs, even though he lost the IEEPA tariff power. He has all the other trade acts and believes he can carry out his tariff needs. He's already been able to get pushed through the One Big Beautiful Bill Act, which has led to stimulus for consumers. So I think the market's going to be a little sanguine about midterm elections, even if it looks like there's going to be a shift in power in Congress, because we're not pushing through a lot before the midterm elections, and I'm not sure there's a lot the president will want from Congress after the midterm elections either.
What is the most significant development outside of what we have seen in the crude oil space? What is the most significant development for you that you're kind of hanging your hat on if you have to maybe be a little tactical, change course in the equity market? Is there something that's happened recently that's created a bit of rethink? One thing that jumps to my mind is the research report from Citrini a couple of weeks ago, where everybody was kind of re-examining the thesis around AI disruption. We saw how it hit various industries, software companies, wealth management firms. Is there something that's happened recently that is really giving you cause to be more reflective than usual?
So I think about two things. So one, relative to artificial intelligence, we were emphasizing diversification before this all went down, right? Before we saw that drawdown, we'd still emphasize it coming out, right? So if you've been overweight artificial intelligence, maybe it's now not the time to get back overweight. But if you'd been taking advantage of other sectors and you've had your run up in energy and industrials and you're underweight artificial intelligence, we'd look at that. I think the second factor we're paying attention to, but we don't think it's a long-term problem yet, is private credit. I think the fallout from a couple of companies and their redemption issues speaks to how difficult it is in private credit to match up duration properly. Right, you really need to pay attention to the liquidity terms of a fund, right? Its redemption periods relative to its underlying investments, and that's one of the problems I think we're seeing. We'd watch for if it means that there's an underlying underwriting problem, maybe a distress or a default problem. We're not seeing that yet, right? We're actually seeing defaults come down when we look at the bank loan space, right? This is a fairly concentrated problem, but certainly those stocks have been hurt very badly. You're seeing discounts to NAV in some of those BDC vehicles, right? That's something we're going to have to watch and make sure it's okay. We think there's still opportunity in private credit, but we'd pay attention to slightly different security.
If there is a question about the strength of the economy overall and the degree to which it may be negatively impacted by what we're seeing play out in energy, How do you feel about small caps right now?
Yeah, they've certainly had a tougher go in the last couple of weeks. And I think a lot of that has to do with the backup we've seen in rates, right? And so I think if we can get through this in short order and the Fed looks like it is going to cut rates some more, small caps are really well positioned. I think if energy costs stay elevated, it's going to be a little tougher road for small companies at this point. Right.
So at the moment, I think the money market is betting on only 45 basis points in Fed easing between now and the end of the year. So that's less than 2 full quarter point cuts. Is that the way you see things right now? I mean, how are you evaluating what we're likely to see from the Fed?
I think we're very much waiting, as they are, for data. I mean, one of the interesting things for us when we look at the December dot plot, and I know that's a little old as we're in March now, but when we look at the December dot plot, what we saw was 17 forecasts with a lot of, we don't know what's going to happen, right? We're just not sure. Some of them thought they needed to cut. Some of them thought they could stand pat. And I think that's very much based on the speakers where the committee remains. We'll look hard at the March dot plot to see what they're saying. But I think we're all a little data dependent at this point to tell us how many cuts we're going to get, kind of no matter what. And the surprising thing has been PPI, producer prices, came in a little hotter. Mm-hmm. PCE, personal consumption expenditures, came in a little cooler. I think it's important to see where inflation comes in, and it's going to be important to see where Friday's jobs data comes in, right? Is the jobs market still robust, or does the Fed need to worry about a slowing labor market? Okay,
Rob, thank you so much. We'll leave it there. Rob Haworth is Senior Investment Strategy Director at U.S. Bank Asset Management Group, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We're seeing a significant decline in South Korean stocks as the result of the war in Iran. Consider the fact that South Korea is a major oil importer. Now, the Kospi was down by as much as 6% earlier, and chip heavyweights like Samsung and SK Hynix were the big drags. That's where we begin our conversation with Kerry Craig. Kerry is global market strategist at JPMorgan Asset Management. He spoke with Bloomberg TV host Avril and Heidi Stroud-Watts.
Kerry, what stood out to us was the decline that we saw in a market, South Korea, that had been leading the pack higher for much of this year. I mean, how are you viewing the ructions we're seeing in South Korea at the moment?
Good morning. Well, I think what we're seeing across the Asian morning open here is obviously a continuation of a bit of the sell-off we saw yesterday in the US. There's still the concerns around the escalation of the conflict in the Middle East and how long it could last, and then the knock-on effects from the potential closure of that Strait of Hormuz for a longer period of time, which would flow through to restricting the energy that was available to markets like Korea and Japan, who are big energy importers. So I think that's probably on the macro front. And then on the market front, obviously markets there have done very well. So you're probably seeing a continued repositioning by investors, taking a little bit of what's done very well in their portfolios, looking to rotate that into more defensive positioning as they sort of weigh what the scenarios that may play out in the Middle East and the duration of which is the big question at the moment. So I think it's probably a little bit more of the rotation within portfolios that's driving this, rather than thinking about a big flight away from risk assets at the moment, given the questions we still have around the severity and duration of what the conflict in the Middle East may look like.
Do you think then there is more selling to go when it comes to Korean assets?
I think the market there has done very well, and it's been underpinned by a very strong secular theme around both the AI stocks as well as thinking about some of the defensive positioning that comes through in terms of the build-out in Europe, given their focus on wanting to increase some of their defensive capabilities after the Ukrainian-Russia conflict. So there's big structural supports there for the market. Obviously, valuations had moved up a long way, and I think when we look at the North Asian markets, whether it's Taiwan or Japan or Korea, they're going to be going back to thinking about their role in that AI supply chain and how that really hasn't changed given what we've seen in the last couple of days. And so that can provide a little bit of a cushion, or should the outlook start to improve, you may see investors that want to move back into those markets at slightly better valuations. That's still a bit early on that question, but I think that there's a longer term case for these markets given their key role in that AI secular theme.
That's kind of what I wanted to get to, because I think even just a month ago, we were talking about the rotation into Europe, into Japan, into emerging markets. All of these markets have been really pummeled, particularly over the past few sessions. We've talked about the sell-off when it comes to the AI scare trade. You are starting to see the emergence of value in some of these markets and companies?
Yeah, there had been a shift in terms of overweights towards that growth theme that had come through, a movement back in towards value that had been going through in Europe for better part of 12 months and has started to appear in the US since late last year. I think the question of whether these prices could fall a bit further and that derating could go further in markets like US and Korea is a little bit too early to tell. I mean, the timing around these things is the biggest issue. I think in the long run, though, you'll still see a lot of investor interest in those markets, given that they are the big producers of memory chips. Then the demand is always going to be there as we see that build out in AI capabilities in the US and around the world. So there will be a point where these markets look a little bit more attractive and you'll find the stabilization. Trying to time that is something that we wouldn't want to get into at the moment, given the uncertainty and the size of the tail risks that are out there at the moment. But I certainly think that there's going to be opportunities that come to the fore in the years ahead. I think right now investors really need to focus on the appropriate levels of diversification and hedges in a portfolio where we do have what could be quite sizable risks around growth. At the moment, the focus is inflation, and depending on how things develop in the Middle East.
It's interesting. We've had a pretty stellar earnings season here in Australia. Australia's always an interesting one when it comes to, a diversification or a place of safety when there's global uncertainty going on. Are there opportunities in the Aussie market?
Well, certainly it looked like on Monday that the market here hadn't been as affected, and I think you're seeing a bit more of a sell-off come through this morning and yesterday. The currency also taking a bit of a hit, given it as a beta currency and cyclical to the rest of the world. I think those same continuations around some of the repositioning in portfolios and balance will come through. I think a healthy rotation we had seen in the Australian market last year was towards thinking around more of the resources side and a little bit less on the financial side. Again, if it's a case of thinking about a bit of an inflation shock that may come through rather than a deep-seated growth shock, you should see those continued rotation towards the resource and materials names do a little bit better in that environment. And again, I think as investors look for ways to provide a bit more diversification and resilience in portfolios, income is obviously a key part of that, and the Australian market as a relatively high income generator can offer a little bit of a buffer in that regard.
That was Kerry Craig, global market strategist at JPMorgan Asset Management, speaking with Bloomberg TV host Avril Hong and Heidi Stroud-Watts, bringing you their conversation here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.